Welcome back for part number 3. Now we really start to get in kind of the meats and potatoes of things in terms of maybe some things that you've seen around and you're like, I just don't quite get what exactly does all that mean. So we're going to be talking about currency pairs, quotes, pips, and more. I'm thinking this will probably need to be divided into 2 parts because I do not want to put together some like hour and a half straight video. So I'll keep my eye on the time and we may have to cut this into 2 parts. Just so that you can, I don't expect you to sit here for the next, 4 hours straight learning about this stuff. I mean, if you want to, then props to you. I like your beast mode work ethic. But like I said, from a presentation standpoint, I'd prefer not to, let this spin out of control time-wise. The first couple I wanted to keep right at 30 minutes, and I went over time on both of those. But I figure, you know what? I'm not going to just all of a sudden cut out information or cut out my thoughts for the sake of saving, 3 or 4 minutes. So, but hey, if it drives you nuts when I go over 30 minutes, I apologize, but I'm never going to let somebody accuse me of not putting in enough information. So anyways, let's start to get into, like I said, the meats and potatoes of things and learn more about, these very important aspects if you're ever going to get involved in trading Forex. Step 1, down at I guess it's not the literal foundation, because the foundation was back in video 1 when we talked about, Forex market, we are trading what is allowing us to make money. Hopefully you're saying, well, the Forex market, you said it about 8 million times back in part 1, but what's allowing us to make money is that values are changing, and those values that are changing are the values of exchange rates. So if you said that, perfect. I definitely annoyed you enough to that point, so fantastic. But going back to that first video, exchange rates are all about what? What are exchange rates actually doing? They are comparing one currency to another. Why do they need to compare one to another? Well, that's how they're going to figure out what direction the exchange rate is headed. An exchange rate, an exchange needs how many people, right? 2, or how many entities or whatever. You can't have an exchange if you just don't have another party. So in order to figure out, well, what's going on with this exchange in terms of the value, is the value going up or down, you got to be able to compare 2 things. And in our case, we're comparing 2 currencies. Hence, that is a currency pair. I should note that I fully am aware that I'm spelling comparing wrong here, but I'm trying to illustrate here that that's why it's called a currency pair, because 2 currencies are being compared. So I'm not the best speller in the world, but I realize that I am spelling that wrong. Now, a currency pair, I just want you to look at this as a list. And a currency pair is a list of 2. So, I mean, how convenient is that? Just 2. Not like a list where you got 8 million things, just a list of 2. So a currency pair is a list of 2, and they're next to each other, and they look like this. So this one is just a currency list of the euro compared to the dollar. Now, if you want to sound smart with your friends, you would say this is the euro dollar, because it is comparing the euro to the US dollar. But that's what a currency pair would look like. So 2 being compared, like I said, the Eurozone compared to the United States. Now here's a little bit more lingo. So major currency pairs, keyword there being major, are any pair that contain the USD, because the world reserve currency is the US dollar. So that's going to be the major currency pair. United States has the biggest government, or not biggest government, biggest economy, GDP, all that stuff. So yeah, anything with the USD in it, whether in the list the USD is here or here, that's going to be considered a major currency pair. So that's what, when you hear that lingo, anytime you hear a major, the one for sure bet is, all right, well, then I know that's got the US dollar involved in the pairing somewhere, whether it be the first in the list or the second in the list. Cross currency pairs, in other words, crosses. These are any pair that does not contain the USD. So when you hear major, all right, that's got the USD. When you hear cross, the one for sure bet is that does not have the USD. So if this was a cross pair up here, you need something like this, and then you'd have to write in some other pairing up there, because a cross pair does not contain the USD within its list. And then finally, the exotic pair is just one major currency compared to the currency of more speculative economies. Again, talked about this in the previous video when talking about, the 4 major markets and how that could change. Speculative economies are going to change. Right now, at the time of this video, Mexico or Brazil are going to be considered kind of speculative economies. I mean, it's not like pure chaos. It's not like some of the countries that you read about in the news. But in this situation, yeah, they're speculative economies, but who knows? My goal is for 10 years from now for this course to still be popular. So if 10 years from now, maybe Mexico has just absolutely exploded, and that's one of the four main markets that you would want to consider when figuring out what time of day do you want to trade. So again, get in the headlines. Just as long as you're reading headlines and stuff, you would see any sort of major switch like that. But that's what exotic pairs are. It's just you have one major currency. I should probably denote that. The one major currency. I'm not saying that it's got to have the USD. Just a major currency compared to the currency of more speculative economies. So you could have the yen, you could have the pound, you could have the euro, anything like that. So it doesn't need to have the USD. Okay, before anything else, don't look at the currency pairs. Please don't. If you want to get your full money's worth, don't look at the currency pairs. I have a question to ask you. We're going to take a look at crosses. So looking at the crosses, what is a bet that you can be very, very confident in? If you were to say, I need to make some prediction. What is a prediction that you can be for sure correct on, knowing that we're going to look at crosses? So I'll let you pause, but don't cheat yourself. Don't look at the slides. Okay, welcome back. If you did pause, the one bet, because we're looking at crosses, is what? You're not going to see the USD anywhere, because remember, a cross is any currency pair that does not have the USD as a part of the list. So, I just want to go over through examples. There are many more than what we're looking at here, but just want to assign a few more, because the cross is like, all right, well, if it doesn't have the USD, then what could it have in it? So I just want to take a look at a few other ones. Over here, we have our cool nerd. So if you want to sound, cool in front of your friends, then you can, kind of throw around some of this slang at them. But let's take a look at a euro cross. So we have EURD first in the list, AUD. What is this whole thing called right here? We get it, Clay. That's called a currency pair because it's comparing this to that. Good. Just want to make sure you're paying attention. Hopefully I didn't annoy you too much. But yes, that would be a euro cross. Why would it be a euro cross? Well, here we have the euro a part of it, so hopefully that kind of makes sense. What about a yen cross? Well, what would you expect to have in a yen? Well, that would be Japanese, and then it's being compared to the CAD, which is Canada. So currencies, I should say, being compared there are Canada's currency compared to Japan's currency. This would be called, these names are fantastic, the loonie yen. Up here we had the euro Aussie, which is kind of boring, especially when we keep going. They only get that much better. What about a pound cross? A pound revolves around Great Britain. So you would expect, well, then Great Britain's currency is going to be in there. The pound's going to be in there. And sure enough, there it is right there. So the pound cross is being compared to the CHF. So this is United Kingdom being compared to Switzerland, which is called a pound Swissy. So not too bad. Not pound sissy, pound Swissy. There's a W in there. And then one more, and this is just totally chosen at random. I guess it's not really random. That's a lie. I tried to choose the one that had like the cool, street lingo, but I arrived at NZD comparing to CAD. So this is New Zealand right here being compared with Canada. And, on the street lingo, that's called the Kiwi Loonie. So if you want to talk with your friends about the Kiwi Loonie and get a weird look from them, I would definitely use that. What about an exotic pair? Now here's a question here. True or false, an exotic pair has to have the USD involved in it. True or false? If you are saying that is true, then you are wrong. An exotic pair must have a currency of a major currency. So that the euro, one of these ones, but it doesn't have to have the US dollar. So it's got to have a major currency, yes, for an exotic pair, but it doesn't have to have the US dollar. Now, certainly the US dollar can be in it because, well, then by, definition, US dollar is one of the, major currencies, but this would be an exotic pair. So right here, United States being compared to Mexico, and this would just be called the dollar peso. For us Americans, I think we're pretty familiar with, especially if you've taken a vacation down to Mexico. I mean, you've of the peso. So this would just be, the dollar peso. But these are just what pairs are. These are what some of the lingo that goes with them. And when you're talking about crosses and all this stuff, I mean, that's the weird stuff that like, wait, what's going on with this cross? It really doesn't matter. It's just a definition, because at the end of the day, these currency pairs are just two things in a list, two currencies in a list, so that they can be compared to one another so that we can figure out what exactly is going on with that exchange rate, because exchange rates change what? Value. And when values change, we can do what as traders? Well, we can trade and make money. we are going to continue on with our quest of making you the cool nerd and just sound like the cool nerd that you probably are in front of your friends. So we're really going to start to break down the currency pair now. You now know what a currency pair is from the surface, perspective. You know what these crosses are and what that's referring to. But now let's actually dissect what's going on with a currency pair itself. So the first, remember, we just have a list. So the first in the list right here is called the base currency. So base currency, just know that, all right, that is the first currency listed in the two-part list. The second part in the list is going to be called the counter or quote currency. You can see it called both, but I think quote probably maybe wins out. But regardless, that is going to be the second currency in the list. That's what I mean about the beautiful thing about just having two things in the list. You have the first thing in the list, you have the second thing in the list. Pretty straightforward. So with that, the first currency in the list revolves around this question. How much does it cost to buy one unit? So again, first currency in the list, the question right now is how much does it cost to buy one of those units? So right now you're probably thinking, all right, yeah, how much does it cost to buy that? I get that question. But I mean, what currency are we using to buy the one unit? Because, thinking back to Billy Bob in Germany, he wanted that food in America, but he wanted to buy that food, but he had to do some other things. He had to exchange. He had to go through that exchange process to be able to do that. So how much does it cost to buy one unit of the first currency in the list? In our case, how much does it cost to buy €1? Well, this is where that second currency in the list comes into play. So the translation of this entire thing right here, so the entire pair this is what it's asking us. How many US dollars does it cost to buy €1? Which is kind of goofy. I mean, that's why I put the work backwards thing, because essentially that's what you're doing. Instead of reading from left to right, like what we do here in Western culture, we're really reading from right to left. How many US dollars does it cost to buy €1? So the first base currency, it's always a 1 over here, because you're just thinking one, insert, whatever this currency is right here, first currency in the list. But, it can go either way, but in my mind, I like to work backwards and look at it backwards, because that's essentially what we're trying to figure out. How many US dollars does it cost to buy €1? That's what a currency pair is telling us. So whatever that second currency is, that's just telling us how much that second currency it costs to buy one of the first currency in the list. So that's the comparison that's breaking down, and it's really as simple as that. So currency pairs may be a little bit intimidating at first. Hopefully now you're thinking, all right, yeah, that makes sense. You have the base currency, you have the quote currency. I don't even really pay attention to that, to be honest. I just look at what's the first currency in the list, what's the second currency. The second currency is telling us how much it takes to buy one unit of the first currency. So I just look at it in the list format. I mean, if you want to sound smart, then you say, well, the quote currency is how much it costs to buy one unit of the base currency. That's how you would say it if you want to say it officially. But in my childlike mind, I just like little lists, especially when lists only have two things in it. Now, this slide is very important because this is what essentially is allowing you to make money in the markets. It's the question that you need to ask yourself, and the question that you really do need to memorize, because when you're looking at a currency pair, this is how you need to approach it in order to, execute the trade. So as traders, we're always asking ourselves, well, what do I think the value is going to do? If it was stock trading, what do I think the value, or in that case, the price is going to do? Do I think the price is going to strengthen or is it going to weaken? In our case, we need to ask ourselves, our case being the Forex market, this question. I believe that, so now right here, you insert the first currency in the list will either strengthen or weaken compared to the second currency in the list. So again, I believe that the first currency in the list is going to strengthen or weaken compared to the second currency in the list. So let's just look at and go again with the euro and US dollar, and this will make a little bit more sense. But this is what's going to lead you to the type of trade you should be making, like I said, in order to execute the trade in the direction that you think it's going to go. So if you're saying, I believe that the, again, first currency in the list, which in our example now is the euro. So I believe that the euro will strengthen compared to the US dollar. Why the US dollar? Well, the US dollar here is the second currency in the list. So I believe that the euro will strengthen compared to the US dollar. If you think that a value is going to strengthen, is going to go up in value, what should you be doing? Well, should you be buying or selling if you think it's going to go up? Well, in this case, you're going to want to buy, or in other words, you're going to want to go long. This is why I didn't want you to skip around. We talked about both of these in the previous video. But that's what you do. That's if you're looking at that. Now, how you're determining whether or not you think that will go up or down, we'll cover that later in the course when we look at analysis methods. But right now, that's how you need to approach the currency. Is you're just sitting there asking, looking at that first currency in the list, in our case, the euro. Do I think the euro is going to increase in strength or decrease in strength? Compared to what, though? Right? Well, oh yeah, compared to the second thing on the list, which is the US dollar. Now, if you're sitting there thinking, I believe that the euro is going to weaken compared to the US dollar. I believe, the euro is going to go down in value compared to the US dollar. Then at that point, you would want to sell short that exchange rate. You would want to, like I said, short it, go short. That's where you would be thinking about shorting because you think it's going to go down in price. And as we learned in the previous presentation, shorting allows you to make money when values go down, when prices go down. In our case, the exchange rate value. So that's how you're going to interpret it. Very important question because that's how you need to approach whether or not you should be buying or selling, whether or not you should be going long or going short is. You got to look at that first currency and what do you think about the currency? What do you think about it relative to that second currency? And based off that, that's going to lead you, that's going to take you to whether you should be, executing a short sale or executing, a long sale where you buy. I do understand though right now it's just definitions, a lot of theoretical stuff. And some people, maybe you got it. Maybe you fully realize it in your mind right now. But other people like myself, I like to just see numbers. I was always in math class. All right, yeah, I get this, that. But could we just throw some numbers up there so I can see how the numbers actually flow through the actual way things work? So now let's add in some numbers. We'll stick with the euro versus, the US dollar. And let's just say for this that the exchange rate currently is $1.45. So the exchange rate, it takes $1.45 of US dollars to buy 1 euro. So I guess I kind of stole the thunder on that one. That was supposed to be a question. Sorry about that. You can email me for a 25-cent refund. I apologize for stealing that question away. But yes, if you were looking at that saying, yeah, it takes $1.45 of US dollars to buy 1 euro, then perfect. You did a good job working backwards. So now you got to ask yourself the question. And you say, you know what? The question, which we've already talked about, and you answer it like this. I believe that the euro will strengthen compared to the US dollar. Meaning what? Well, in this case, what you're saying, well, if you believe that the euro is going to strengthen, if you believe that the euro is going to go up in value, then what is the answer? Well, you should be buying. You should want to buy the exchange rate, aka you want to go long. So you decide, you know what? I'm going to buy 5,000 units of the euro USD currency pair. So let's do some math here. You want to buy 5,000 units. Got it. We already established what the value of the exchange rate is right there, $1.45. So that means it's costing you $7,250. Now, before you freak out, holy crap, I don't have $7,250 for my account. Well, hey, remember leverage from the previous presentation. Now, leverage being responsible, but with leverage, this really isn't too hard to do. I mean, $7,250, not a whole problem to come by. But anyway, so that's what you have in right now cost-wise. It took you that much to buy the actual, allotment of those 5,000 units. So let's just say that, hey, you know what? Your belief is correct. Within the next week, the euro does indeed strengthen compared to the US dollar, and the new exchange rate is now $1.57. So you looked at the pair, you thought, you know what? I think that the euro is going to strengthen compared to the US dollar. So translation, I believe this exchange rate value is going to increase, and it did indeed increase up to $1.57. So now what do we have? So what all does this mean? Like I said, what do we have? Well, hopefully it's putting a smile on your face, because now that the exchange rate has increased, those 5,000 shares of the euro that you bought are now worth, so let's do the math here. Exchange rate has increased. You still have those 5,000. Nothing has changed in regards to that. You still have the 5,000 units, but now the exchange rate, the value of that has gone up to $1.57. So that is now all worth $7,850. And the math here is very simple. You take the worth and then you subtract it by the cost, and that's going to tell you your profit or loss. Now, quickly, you're not going to have to sit here with a calculator and be like, all right, I got to type. I got to pay attention. I got to type. your broker is going to be doing all this for you. This is just so you can get an understanding of what actually is going on. But in a real practical setting, the realistic setting, like I said, your broker, the platform is going to be calculating all this for you. So you're not going to have to sit here and, with your calculator, like you said, or with your spreadsheet set up, and, you're not going to have to keep track of all this stuff. Your broker does that for you. If your broker does not do it, then definitely go find another broker, because that broker must be from like the Stone Age or something, because this is not new technology by any stretch of the imagination when it comes to trading. So I want to get that out of their way there before I forgot to mention. Like I said, this is just more so FYI how things are actually working. So back to our equation, like I said, the worth minus the cost is going to give you the profit of the profit or loss. So in our case, I said the worth of it is now $750 or $7,850. Going back to what our cost was, remember when we entered into the position, it cost us $72.50. So subtract worth minus cost, and that gives us a nice, beautiful profit of $600 on the trade. I mean, just going back to that first video, I mean, that's what the whole point is. We want to capitalize on exchange rate values changing, and in this case, an exchange rate changed, and all of a sudden, we have $600 profit. So, what always kind of just fascinates me is, Billy Bob, he wanted that next hamburger. He wanted those 2 hamburgers again, but he couldn't buy it because the exchange rate changed. So here poor Billy Bob is, maybe he has no idea about the Forex market in terms of trading it, but then we as traders, we could have been sitting there, and because of that fluctuation, in the exchange rate, we could have made a whole lot more money rather than just letting, money sit there and then just totally be influenced by it. So, whenever you see on TV or anywhere, exchange rate this, or, the US dollar is really getting strong compared to, that other currency. I mean, people are taking advantage of that. That's what Forex trading is all about, the changing of those values of exchange rate. So sorry to get all sappy and sentimental on you, but that's why I just love the market. It's fascinating how all this stuff works out. But anyways, back inside of our example, I distracted myself. I apologize. The exchange rate is now $1.57, right? We already established that. And you're like, you know what? I'm focused on this pair. This is the one that I really want to learn and just study and, just stay laser focused on. So you know what? I want to trade it again. So you got to ask yourself the question once again. And you answer the question like this. Well, I believe that the euro will weaken compared to the US dollar. So what does that mean exactly? Well, now your answer is that you should sell the exchange rate, aka go short, because if you think that the euro is going to weaken, that means that you think that the exchange rate value is going to drop in value. And when things drop in value, how can we still make money from that? Review back to, video number 2. Well, that's where shorting comes in. And with shorting, you sell first. So shorting, you're going to sell. So we should sell the exchange rate, which puts us on the short side. So you decide to short sell 3,000 units of the the euro dollar. So again, 3,000 units you decide. And we already established, well, this is at $1.57 exchange rate. So that is going to cost you $4,710. Remember, leverage, if you're thinking that number's huge, you got leverage in your favor. But in this case, your belief is actually wrong. Within the next week, the euro strengthens, so that exchange rate value compared to, the US dollar goes up, and now the new exchange rate is $1.62. So when we're on the short side, remember, you want prices to go down. If prices go up, you are losing money. So in this example, what exactly does it mean? Well, you can't win them all. So in this case, this would have been a loss. Let's go through the actual math here. So because the exchange rate increased, those 3,000 units you bought are now worth 3,000 units. That didn't change. What did change was the value of the exchange rate. So now that's worth 4,860. So we got to go back to our equation. You got to calculate worth minus cost, and that's going to give you the profit of loss. But remember, the big thing here is when selling short, you want the worth to go down in value. So the worth number, you want to drop. The lower that worth number gets, the better for your short-sided trade. If you're brand new, just read and sorry about that. My annotation tool freaked out. But if you're new, read and just understand that you want values to go down when you're shorting. So in our equation, you want the worth to go down in value. Everything about shorting, you want everything to go down. So in this case, it's worth $48.60, but it originally cost you $47.10. Now, if you had gone long, hey, if you had bought, that would have been a $150 loss. But because we went short and the price went against you, the value went up, that equals a $150 loss. But let's just put the KISS method into, deploy the KISS method. Keep it simple, stupid. So at the end of the day, this is how it all breaks down from a trading perspective. If you believe that a currency is going to strengthen, if you believe that if you want things to expand, so if you believe that a currency will strengthen, you want the exchange rate to strengthen itself. Strengthen meaning going up. If the currency does strengthen, then hey, you make money. If the currency weakens, you lose money. So again, if you believe the currency will strengthen, you want the exchange rate to strengthen. You are going to be buying in those situations. So therefore, because you're buying, if the currency strengthens, if the currency goes up, hey, you bought, you're going to be making money. If it weakens, well, you bought, you're going to lose money. On the flip side, if you believe a currency will weaken, you want the exchange rate to weaken. So if you believe that a currency is going to go down in value, you want the exchange rate to go down in value. Therefore, you are going to be looking to sell short. You're going to be looking to short. So in this case, if the currency strengthens, if the value goes up, remember, value is going up when you're short, not good, you're going to lose money. But if the currency does weaken, if the currency goes down in value, then from the short side, you are going to make money. So those 2 bullet points really kind of just summarize everything of the mindset that you have and how essentially, the Forex market works in regards to, so I believe this, therefore that. I believe this, therefore I want that to happen. That's what's being all summarized here. So that's how the numbers are working out. This is how, you read a pair, and then by asking that question, it's going to lead you right to, well, should you be buying? Should you be going long, or should you be selling? Should you be going short? Looking down here at the time, we're just at about 30 minutes in. So I'm going to go ahead and cut off this one, and we'll come back next and talk about Forex quotes.